Hi, this is Professor Nugent, and this is a review of what you should learn in Business 330 Finance. So, the course starts out typically in the role of the financial manager. And the first chapter of the book will talk about what is finance, defining finance, and the managerial functions as finance as the first learning goal. The second learning goal in Chapter 1 was the legal forms of business, such as sole proprietorship, partnership, corporation. And it discusses the advantages and disadvantages of those three forms of business. The third learning goal of the first chapter was describe the goal of the firm and explain why maximization of the value of the firm is an appropriate goal for business. So this is what sets up the whole premise of finance, which is to help companies maximize shareholders' wealth. And one of the reasons that we ran the Zoom simulation in 330 was to reinforce and show that companies are judged upon their ability to maximize shareholders' investments and shareholders' wealth. Learning goal 4, describe how the managerial finance function is related to economics and accounting. So in this area of the first chapter, it starts making connections between finance and economics and finance and accounting. So finance is often an expression of economic situations and economic realities, and accounting is the language of finance. So accounting is the record keeping and the organization of the data the financial managers utilize to make decisions. Okay, learning goal 5 from chapter 1 was identify the primary activities of a financial manager. And here we talked about basically what the financial manager does, how he spends his time, what he's responsible for, and basically the financial manager is responsible for running the financial aspects of the company, the cash, managing the capital budgets, capital structure, uh, dealing with most aspects of capital, which is money, and related to the corporation, and investing for the future and maximizing shareholders' wealth. So chapter 1 talks a lot about what the financial manager does. And then lastly in the first chapter, they describe this nature of the principal agent relationship between the owners and the managers of a corporation. So it looks at, it explains that financial managers are agents who are basically acting in the best interest of the owners of a corporation. And corporate governance is the mechanisms to make sure that managers stay on target with these goals of representing the ownership of the corporation and not representing themselves or doing what's in their own best interest, but what's in the best interest of the company, in solving problems that will lead to maximizing the wealth of a company. Okay, so chapter 1 is just a basic introduction setup for the textbook and what we're going to focus on, which is the role of financial manager moving forward. But the first half of the textbook, covered in 330, is just laying the basic framework or foundation that financial managers must know before they move into actually managing a company. Okay, so let's move into chapter 2. So in chapter 2, we start talking about the financial market environment. So in the financial market environment, we want to look at how financial institutions are going to affect managerial finance. So financial institutions we're talking about brokerages, banks, financial markets such as stock market, bond market, options market. So we want to give an idea of the institutions that financial managers are going to interact with. And then the chapter goes in to look at the functions of these financial institutions and financial markets. So financial institutions interact with financial markets in a way depending on the direction of the flow of capital. Generally, savers bring their money to financial institutions, and the financial institutions take that money and invest it in the financial markets. Then corporations will go to investment banks to access the financial markets to raise capital, such as stocks and bonds. Okay. Now, describe the difference between capital markets and money markets. And it talks about the money markets are short term in the framework of 12 months or less, and capital markets are long term, greater than a year. In Learning Goal 4, we talked about the root causes of the 2008 financial crisis and how that affected financial managers and corporations and financial institutions and markets. And basically, 2008 was a real turning point where we looked more closely at what financial markets were doing, how financial institutions such as banks and mortgage brokers were affecting the risks of financial markets, and how investors weren't fully understanding the risks involved, the negligent or fraudulent illegal activity that occurred during the Great Recession. Okay. And also in Chapter 2, we talked about the regulatory bodies that manage and monitor the financial markets and institutions. And lastly, we discussed business taxes and their importance in financial decisions. And we showed how to calculate business taxes for corporations at various levels of income. Okay, moving on to part 2 of the textbook, where we go into Chapter 3, which is financial statement and ratio analysis. And this is always, financial statements are covered in financial accounting and also in finance. So financial statements are something that you've seen in multiple courses, even Introduction to Business, as well as ratio analysis. So Chapter 3 in itself, when you're taking 330, is a review and and it builds upon what you've learned in previous courses. So here again, we look at the shareholders' annual report, and we want to understand how do companies report their information to shareholders and owners. And shareholders are technically owners. And how are these financial reports utilized in understanding how a company is doing? So we looked a lot about understanding financial ratios and how they're calculated, using the ratios to analyze a firm's liquidity and activity, discussing the relationship between debt and financial leverage, and the ratios used to analyze a firm's debt. There's a whole set of ratios that are debt ratios. We looked at ratios to analyze a firm's profitability and its market value, and we used a summary of financial ratios in the DuPont's system of analysis to perform a complete ratio analysis. So in Chapter 3 is pretty pivotal chapter as far as what we're discussing. So the stockholders report, or I think of it as an annual report, is really putting all the pieces together and explaining to stockholders what the company has done, and in a financial sense, using income statement, balance sheet. And the chapter goes into discuss the 4 key financial statements. So, of course, the first one is the balance sheet, which shows where the company is at this point in assets and liabilities and equity. The chapter talks about the cash flow statement, analyzing and interpreting cash flow from operations, investments, and financial activities. And of course, the chapter goes into the income statement, analyzing the revenues, the expenses to get the net profit. So the basic concept of this chapter is that financial statements are great and they have a lot of detail, but too much detail, and it's not easily comparable between companies. So financial ratios were developed to more easily understand and interpret the progress of a company and make it comparable to other companies. So the chapter goes into financial ratios, looking at financial ratios across an industry, looking at financial ratios in the time series of one company, doing combined analysis of an industry and time series, and then give some cautions about ratio analysis, that you can't base your decision solely on ratio analysis. You need to know more about the company, because there are some exceptions or some causes inside of the financial statements that need to be pulled out or looked at more closely, such as a merger or acquisition, such as a huge tax loss or gain, such as a winning of a lawsuit. So these are things that have to be looked at. And of course, it goes into depth of liquidity ratios and talks about the main liquidity ratios. Let's see. It's going to look at the activity ratios in the which activity ratios are more the management of the company, looking at accounts payable, accounts receivable, inventory, the debt ratios, how they manage their debt and the coverage of debt, the profitability ratios, net profit, gross profit, operational profit. And these are things that, again, were reinforced greatly in the Zoom simulation during the BUS 330 course to show how you manage your company results in the change and the dynamics of financial ratios, including earnings per share, PE ratio, things of that nature, market versus book. And then as far as summarizing all ratios, we had these broad categories of liquidity, activity, debt, and profitability. So these are three areas that the ratios can greatly help us to give a better understanding of how the company is progressing. Okay, so then we move into chapter 4, which is cash flow and financial planning. And here we're trying to understand, we get more in depth to this concept of depreciation and how depreciation affects the cash flows of a firm. And we discuss the firm's cash flow statements and specifically operating cash flow and free cash flow. We look at understanding the financial planning process, including long-term strategic financial planning and short-term financial planning. We discuss the cash planning process in preparation, evaluation, and use of the cash budget. And we simplified the procedures and prepared to develop the pro forma financial statements of the income and balance sheet. And the pro forma financial statements are basically what we think is going to happen next year. And we saw the same thing in the Zoom simulation where we put our statistics in, and the simulation will produce a pro forma to show us what we're most likely to make next year if we meet our sales goals. If you don't meet the sales goals, then you see that what you expected to happen didn't happen because you didn't sell everything you forecasted, and your actual financial statements won't match your pro forma. Evaluate, how to evaluate different approaches to pro forma financial statements and in the preparation of how to create them. So this chapter is pretty pivotal. Let me just resize the scale of this. Hold on a second. Okay, that's better. Just trying to maximize the screen viewing area. Let me see if I can open this up a little more. And what I'm trying to do here is make our viewing area a little bit better. Okay. So chapter 4 introduces this element of cash. And, the one thing that's very important is understanding with depreciation. So depreciation is a non-cash charge. So we use it to reduce our net income to pay less taxes, but we have to add it back in when we calculate our cash flows. And of course, depreciation is depending. It's just the idea of assets become less valuable as you move forward in time, and they need to be their value needs to be represented or reduced on the company's financial statements. And this is all through the IRS details. This is the modified accelerated cost recovery schedule that we use in finance, and it's dictated by the IRS. And this helps us to, when we're preparing a cash flow statement, we have to, take into account our depreciation expense and our accumulated depreciation. So this is all explained in chapter 4, and that would affect these things do affect the balance sheet and the income statement. Okay. Then, of course, the chapter goes into this operating cash flow formula, and it talks about the free cash flow formula, which are two concepts of, operating cash flow and free cash flow. There's a difference. With the free cash flow, we're looking at the available cash to investors after the firm has met all their operating needs. So one is looking at the cash flow of the operations and the remaining cash that's available to investors. Okay, so the chapter goes on to look at how to do short-term and long-term strategic planning, specifically related to cash and cash flow of a company, making sure company cash is like the oil in the engine of a company. If what happens to your car if it runs out of oil, it seizes and the whole car is ruined. The same thing with a company. If a company runs out of cash, the company will seize, go bankrupt, and the company will most likely be ruined. That's why in chapter 4 we develop these cash budgets and we look very closely at the sales forecast, which is this chapter ties in again very nicely to the simulation you ran in 330 where you had to develop a sales forecast, and the sales forecast would be used to make the pro forma financial statement, and therefore at the bottom of the finance page you would have a cash surplus or deficit, which was sort of like a really quick cash budget. If you had a deficit, your cash budget was bad, and you had to rethink how you put your company together. And then, as far as the sales forecast, you have the external and internal forecasts to help guide the situation. So the external forecast is really the relationship between the company and external indicators such as the industry and the economy, and the internal factors would be more the firm's own sales channel and sales force and what they're showing and predicting. So sales forecasting is complicated in the real world. It is really challenging. But this cash budget is prepared, and a lot of the rest of the chapter goes into how a cash budget is prepared and details the relationship between the different accounts in the cash budget, which is something that is pretty critical for a company to develop. Okay, so this is an example cash budget here, and it goes into all the details of that, and then how it links to the pro forma financial statement, which again is strongly addressed in the simulation, and it just kind of goes over how to prepare a pro forma financial statement using a percentage of sales method. There are a couple of methods for doing. You could use a judgmental method, preparing pro forma financial statements, and how to evaluate the pro forma financial statements. So that's pretty much chapter 4. Then we move into chapter 5, which is the time value of money chapter. And again, this chapter is likely to be before you even got to time value of money, you might have done this type of work before in other courses. So time value of money is really looking at how money, because of inflation, changes in value through time. So this chapter looks to give you computational tools to actually calculate the time value of money. So we want to understand in this chapter, we understand present value and future value of money and how they're calculated for single sums. And then we move into the present value and future value based on annuities, how we can look at an investing or a savings or a payment such as a mortgage or a car on an annuity basis, which is a series of cash flows. And then we looked at calculating the future value and the present value of firms and mixed streams. What if it's not an annuity? So annuity is a constant stream, but a mixed stream of cash flows. Then understand the effect of compounding and the interest and the frequency of compounding effects on your overall ending result, future value of your money, and looking at the procedures involved in determining deposits needed to accumulate to a future sum. So if you wanted to save $1 million, how many deposits would you need to make given your time frame to save to that amount? Or also loan amortization, finding the amount of your loan payment based on the size of your loan and the time of your loan. We also looked at formulas to calculate the growth rate, to calculate the number of periods if it's unknown. So this chapter goes in quite depth of time value of money and the role of time value of money in finance and why it's important, how compounding or discounting. Compounding leads to a future value, discounting leads to a present value. So this is a very important chapter for you to review because this chapter is utilized in, when we're moving forward in this class, it's connected to a lot of other chapters. So in this chapter, of course, we talked about how to use the formulas to calculate single values, annuities, mixed streams, mixed stream events, and then also and it goes use compounding more frequently than annually. So if you want to do quarterly, semi, monthly, and also this chapter has a lot of good Excel information within the chapter. And then we move into part 3 of the textbook, and the first part of part 3 is interest rates and bond valuation. So this chapter, when we talk about this chapter, um, we're talking about the basics of interest rate and how that affects business. So we want to look at the role of interest rates in overall planning and overall calculation of return. So we have to understand the basic structure of interest rates and the risk premiums, look at the legal aspects of bonds and financing through bond debt, discuss things as yields on bonds, prices on bonds, ratings of bonds, popular types of bonds, specifically corporate bonds, looking at the bond valuation process, and talking about the impact of bonds and the maturities and the change of interest rates and how they affect bonds in this chapter. Okay, and the calculation of bonds and calculation of bond yields and returns, this is all rooted in the time value of money chapter. So you really need to understand the time value of money chapter before you can understand chapter 6. Chapter 7 is about stock valuation. Now, in my class of 330, I didn't go into too much depth of stock valuation, but some other sections of 330 did. It doesn't connect too deeply to the rest of this textbook, but it just gives you the basics of what a stock is, and it talks about debt and equity, and looks at different types of stocks like preferred stock, common stock, going public. It looks at different valuation methods of valuing of stock valuation, which is zero growth, constant growth, variable growth, which are models that utilize a dividend rate. And then we talk about how using a free cash flow model or book value or liquidity valuation to value stocks. So it's just really an introduction to stocks in general. Okay. Moving to part 4 of the textbook, we go into the risk and return chapter. And this chapter also brings in a lot of details and information from the time value of money chapter. Now, in this chapter, we look at risk, defining risk and understanding risk, and how to address and measure the risk of a single asset. So risk is really important in business because the more risk that you get involved in, the more return you need to compensate you. So that's why we need to measure risk, and we can use things as a standard deviation of our portfolio or correlation to understand and manage risk better. We can look at the characteristics of risks in portfolios and the correlation and diversification to help minimize those risks. And we talked about the two types of risk and the deviation, the role of beta in measuring the relevant risk of both the security and the portfolio. And we talked about using the capital asset pricing model to develop a relationship between the risk, which is expressed by beta, and the company. So chapter 8 is really, in the beginning of chapter 8, we're trying to define risk. What is risk and its fundamentals? We're looking at return, how, return is a measure of the results of the investment and how did that compare to risk. And we're talking about, different risk preferences and the risk among treasury bonds, bills, and stock, how the risks are different. And then, of course, we look at risk of a single asset, which is easier to define and make a risk assessment. And of course, then we apply the risk to a portfolio and the return of the portfolio using capital asset pricing model. So chapter 8 is really giving you the basic framework for measuring return and the risks associated with that return. Okay, and then this leads directly into the cost of capital chapter. So in the cost of capital chapter, we're talking about why capital is important. And the basic concept of the sources of different capital for a company. Remember, capital is money. So when we're talking about capital, we're talking about the money of the corporation, and where is the corporation getting the money? So, and what's the cost of that money? Because money is never free. There's always a cost. So we need to determine the cost of debt, which is one big source of money for a company. So, and we have to look at the tax. We've learned about how tax plays into the effect of the cost of that capital. Since there's a tax reduction for using debt and interest, the actual cost of the debt is lower than it may seem because we have to factor in the tax savings. Then we talked about the cost of preferred stock. We talked about the cost of equity versus, common equity, retained earnings, and issuing new equity. And then we developed this concept of a weighted average cost of capital. So, of course, we reviewed this chapter does a good job of reviewing the cost of capital. What is the for the concept of the cost of capital? What does that mean? Where are the costs coming from? And we specifically looked at the long-term cost of debt and explained how that is calculated. Talked about net proceeds and flotation costs, the different aspects of that long-term cost of debt. We looked at the cost of preferred stock, and of course the cost of the common stock. And more importantly, at the end of the chapter, we discussed this weighted average cost of capital formula, where we took the different sources of capital and we weighted them by the size of the capital in the pie and come up with an weighted average cost. That's important for investors. This is what you use to figure out how to make your investments, or what investments you need to make, because your investments have to return more than your cost of capital. Okay. All right, so we just close. And then that led us into, after we do the cost of capital, then, let me just close this. Then we start moving into the part 5, which is the capital budgeting techniques. So the capital budgeting techniques is an area where I'm going to spend a little bit more time in the next lecture talking about the capital budgeting techniques, because the two chapters, the capital budgeting techniques, lead directly into the capital budgeting cash flows. Now, for my Business 330, I stop here after I go over the capital budgeting cash flows. Since not everybody took 330 with me, you may have not gotten to the point where you discussed capital budgeting and capital budgeting cash flows. So I'm going to represent these two chapters because I want everybody to start the course at a pretty common footing. Since I know most people in the other 330 sections definitely covered up to cost of capital chapter 9, which is what this review is really basically, chapters 1 through 9, which I'm assuming you've covered in some aspects in your 330 finance course, that you should, in this class, for this first week of the course, you really need to, I want you to go back and review these chapters, and there's a homework assignment that's linked to the review of these chapters. And as we move forward, we're going to move into next week, we're going to talk more specifically a more in-depth review of chapter 10 and 11. So you may or may not have done chapter 10 or 11 in finance, but it doesn't hurt to review it, and there'll be some homework associated with these two chapters moving forward. And then in the week following, we'll get into chapter 12, which is risk and the refinement of the capital budgeting process, before we move into the rest of the textbook. So really the purpose of these first 2 weeks of this course is to really strengthen and reinforce the knowledge of what you learned in the first, say, 12 chapters of this textbook before we move into the remaining chapters of this textbook. So don't feel overconfident that you don't need to put any effort in here if you already feel like you covered this, or you took 330 last semester, because some of you may have taken it last year or 2 years ago or 5 years ago. Either way, no matter how long ago it's been, it doesn't hurt to go back, reread, or even at least skim over the first 12 chapters of this textbook, and say the first 9 for week 1 and chapters 10, 11, 12 for week 2, to really give yourself a good solid foundation before we move forward on the remaining chapters of this textbook, which we'll cover in a much slower, more methodical, more detailed way, since there's going to be new material to everybody. Okay, so this is my week 1 lecture on the review of the first half of this textbook. Okay, if there are any of the chapters you feel that you want a little bit more in-depth lecture on my YouTube channel, I do have a Finance 330 course a set of full lectures for each of these chapters that you can go back to, and you can actually view the full presentation, the full lecture if you wanted a little bit more in depth, or you felt that your course didn't cover one of these chapters completely. This would be the area to go to really get that reinforcement. Okay, thank you, and I'll see you on the next lecture.